Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at what stocks usually do during periods of hyperinflation. Now, cases of extreme inflation or hyperinflation have happened many times through many countries over thousands of years, which gives us many cases, many data points, a lot of information to work off of when trying to determine what happens during periods of extreme inflation to something like stocks. Well, in short, the answer is that stocks go up. That might sound counterintuitive, and so if all you wanted to know was whether they go up or down usually in periods of inflation, that's the answer. If you're wanting a little bit more as to why and kind of what the end result is after that period of extreme inflation, stick around. Let's dive in. Take a look at these charts here. I'm just going to flip through a bunch of them. These are stock market charts of asset prices through countries like Zimbabwe, Argentina, Venezuela, the Weimar Republic, and Germany. These are all places that have had extreme cases of inflation. And as you can see, all of these charts move up and to the right. Now, again, this might be a little bit counterintuitive to think, hey, if there's a hyperinflation or extreme inflation usually happens when there's some sort of economic collapse going on. If you look at what's happening in Venezuela right now, it's not exactly a place that people are fleeing to for opportunities to get rich. Yet when you look at their stock market, it might look like it is telling the opposite story. And there's two main reasons why the price of assets go up, and in some cases go up extremely far and fast. There are two main drivers behind this. The first one is basically just supply and demand. Think about the economy like a company, and then think about the money in an economy like the shares of that company. Ultimately, money just represents shares of purchasing power per the economy. Of course, it's a little bit more complex than that, but the example holds up and it represents the point that I'm about to make really well. If you take a company and you take it through a stock split, something similar to you've seen just recently Tesla and Apple did, and let's say you double the number of shares, that means you've doubled the supply of shares. Well, nothing happens to the value of the company. That's a neutral move. It's like taking a pizza and you take it from 8 slices to 16 slices. You didn't make any more pizza with that. All you did was you took each existing slice of pizza and cut it in half. So yes, there's twice the number of shares, but they're each worth half of what they were before. Similarly, if you take an economy and you take all the money in that economy and you do a stock split with that money by just doubling the amount of money that's in the system, you're not creating any new wealth. Money just represents the ability to purchase wealth. Money is essentially shares of an economy. Now, if you take a look at this chart, you can see this is the total money supply, and you can see how often it has doubled throughout time. Now, if you recall, during any of these periods where the total money supply has doubled, your bank account has never doubled as a result. Yes, you might have gotten raises along the way, but your dollar was never multiplied into $2 at the same time and frequency as the money supply. Now, the reason for this is simple. The money supply is increased for specific reasons, and that money is not going to be evenly distributed throughout the society because immediately the price of everything would then double as a result. Just like when you do a stock split, immediately the price of the stock is cut in half. And so there would be absolutely no net effect on the economy whatsoever. And so instead of evenly distributing all the money to everybody, they target it specifically and most prominently to government. And so government usually gets the prime benefit of the new supply of money, and they get to spend that money at the old prices before the system realizes that there has been a massive quantity of money entering the system. And then as that new money makes its way throughout the system, the price of assets, the price of stocks, the price of goods, products, goods and services, and then eventually the price of labor or wages will all adjust accordingly. Now, another way of stating this whole thing is that you just have more money chasing the same amount of goods and services. And so whether that's from an increase in the total supply of money or not, whenever you have more money chasing the same supply of something, it will drive the price up until that price meets the demand. We all saw fantastic examples of this as people were buying supplies out of stuff that they wanted due to the recent coronavirus panic. And even now, there are still a lot of things where prices are a lot higher than normal. Things like ammunition, guns, camping and outdoors equipment, at-home exercise equipment, emergency-style food. There are a lot of things that have experienced a massive increase in the total amount of money that's chasing those goods and services, which bids up the price. People are willing to pay more to get their hands on those items. And so similarly, if you have a massive amount of money enter the system where the total quantity of money increases, that means everything in the system will start to experience more money chasing those same goods and services, which will eventually push the prices up. It's simple supply and demand. And so this affects stock prices just as well as it affects other prices. Now, the second main reason why inflation and hyperinflation pushes stock markets up and to the right is because of the question of where to invest. When money is increasing rapidly like this, money becomes plentiful. And so things like bonds at zero interest rates are what have been called return-free risk, because the bond prices can't really be bid up that much higher, or else the return on them becomes negative. When the bond matures, the amount of capital that you get back at maturity plus the interest you've collected along the way would be less in total than the amount of money that you used to purchase that bond in the first place. And so bonds are at their high where they can't really be bid up higher without pushing the return into negative territory. At the same time, bonds have a long way to fall. If people decide to stop investing in bonds and start to sell them all, well, they can keep on dropping until they're, theoretically worth zero. And so bonds are not a place right now where a lot of money is going into because they're essentially, like I said, return-free risk. Now, they are better than cash, which cash doesn't provide any interest whatsoever. And so as inflation ticks up and as the cost of things get more expensive over time, if you sit on cash, that cash will not purchase as much stuff for you every year if you're just sitting on that cash. And so as an investor or as a saver, you need at minimum to meet inflation, or else you're actually losing real purchasing power. And so if you can't stay in cash and you can't stay in bonds, that pushes all that new money that's being created into more speculative investments like the stock market. And as more and more money is created, and as all that money is trying to find a place to stay, it's going to push up stock prices, which means it makes the actual investment value of those stocks even worse. Because if nothing changes about the company, if they're not increasing their dividends, if they're not increasing their profits, if they're not increasing their revenue, if the company stays the same, but the price moves up, that investment becomes worse. And so most of the stocks out there that would have been considered value stocks at one time, all the money has already rushed into them and pushed the price up so high where they're not value stocks anymore. And all of the growth stocks that are out there that had potential for high growth, maybe the company has potential for high growth, but the stock price has been pushed up to such a high limit that it's already priced in years or decades worth of growth that company might have in the future. And so the question of where can I put my money when you consider it from a macro perspective, from all of the hedge funds and all the pensions, all the mutual funds, all the really wealthy investors that have most of the money in the system, it has pushed them into investments that have pushed prices up to a point where any new money coming into the system has to chase more and more speculative investments, and any value and growth that might have been laying around in the stock market has been arbitraged away. Now, this brings us to the inevitable question, which is what happens after the crash then? Because ultimately we know these things don't go on forever. Eventually the system collapses, eventually the economy crashes, eventually there's a big depression or a big recession. And so what do these things look like at the end? Well, eventually, normally people just start pricing things in other money. Many times throughout history that's been gold, many times it's been silver. It could start to be Bitcoin, it could just be another currency, but ultimately when people realize it's really meaningless to measure my returns in this currency that's being hyperinflated away, in our case it might be the dollar soon, well, you're just going to stop measuring things with the dollar. So usually the crash has already happened when you're measuring it with other more stable forms of money. It just never shows up when you measure it in that fiat that has collapsed. In the end, yes, these assets almost always outperform the fiat that they're being measured with, because as that money is being created, it floods into those assets, which pushes the price of them compared to that fiat up. But assets, just like anything, are still governed by the laws of money, which means that you might not notice that your house is shrinking every year if the ruler that you're using to measure your house is shrinking even faster. You might even think that your house is growing. But the first time you try to walk into the door and you hit your head on the door frame, you'll realize something is wrong. And usually by the time that the public realizes something is wrong and that the money that they've been using to measure the prices of things is no longer worth anything anymore, it's usually too late to do something about. Thank you so much for watching. If you enjoyed that video, hit the like and subscribe button so that you can continue to see videos like this. You guys are the best. Have a great day.